this whole November has just been, I'm going to say it, a regime change. It's been tentative all year. But you can tell investors just getting very excited. The first chart here is equities versus fixed income ETFs. And you can see here's equities, right? And here's fixed income, right? So TLT in particular is dragging down fixed income. Equities being led by both U.S. and international ETFs. Even Japan is in the top 5. So a lot of excitement for equities across the board. That's one. Number 2 is sectors. Sectors is where you tend to see regime changes and changes of mood play out early, because a lot of traders use sector ETFs. So here we have tech versus staples. Look at tech flows. Boom, up here. Staples kind of down here. Tech is also being driven by things like the Qs, XLK, the Internet ETF, and tech has obviously had a good month in terms of returns. That's what's really behind a lot of this, the flows. Now let's look at factors. Now, a lot of talk about value versus low vol. Value has had a little bit of a comeback, but it just seems like a big deal because value is always bad. So any little comeback we cheer. Growth is beating value this month also, and the flows are showing it. Here's growth flows, and here's low vol. Low vol had been the trade all year, the perfect trade for a tentative sentiment. But growth is coming back, leading performance. And Scarlett, I think I'm ready to call it a regime change. All the signs point to complete risk on.
All right, we'll see how it shakes out for the rest of the year. In the meantime, let's bring in Justin Castelli. He is founder of RLS Wealth Management. And we want to welcome Carolina Wilson, team leader of EM coverage for Bloomberg News. So Justin, as an advisor, have you been adding risk to your clients' accounts? Are they feeling more bullish on growth?
My clients really aren't talking about being bullish, but I have added more equities. So for a lot of my retirees, I have what I would call a tactical strategy. So I mirror this tactical with their strategic, more buy and hold portfolio. And it's a simple 5-fund, 10-month moving average, and it follows kind of the trend and momentum. And I have to give credit to Meb Faber for his Ivy portfolio, because I took that as the blueprint. But as of the beginning of this month, as Eric talked about, the 3 remaining funds that were sitting in the short-term bonds all got moved back in November 1st, which would increase the equity.
All right, we're going to dig into your tactical portfolio a little bit later on, but I want to bring in Carolina first, because to get the lay of the land here, more and more there's a view here that the U.S. outperformance over the rest of the world has kind of run its course, and overweight on the U.S. is an incredibly crowded trade heading into 2020. What are some of the big calls on that?
As Eric mentioned, we're definitely seeing a rotation, a strong rotation back into risk, as that safety trade that really reigned among ETF investors is starting to unravel with sort of signs of a rebounding economy. At one point, we had seen good progress with U.S.-China trade talks. You have Morgan Stanley coming out and saying that their preference for non-U.S. equities over U.S. equities is greater than it was before. And if we look at the ETF investor channel, the flows and the cash there is following that sentiment almost exactly. EM ETFs have seen 6 weeks of consecutive inflows. That is the longest streak of inflows since the first quarter. And even more love we're seeing for developed market funds like IEFA and those tracking Europe or Japan.
And Justin, you sent me your tactical ETF portfolio. I love digging through it. You have SPEM as your emerging markets ETF, but I also found it interesting that the tactical portfolio is for the retirees.
Correct.
It's kind of counterintuitive. You'd think that tactical would be trading and more for people who are a little more into the juice. Explain the logic there behind this being for retirees.
So I'm coming to you from the perspective of a financial advisor. So not a trader, not an investor only, and I'm allocating these portfolios to help my clients reach their goals. So for retirees, they tend to be a little bit more, they get a little scared a little bit easier because they're in retirement, their chance to make money is not there anymore. So I really look at the tactical strategy as keeping them in the markets when risk is on, but having a strategy that's not my gut, trying to determine when to move more conservative when things go south. So it will drift the portfolio, and if things would go south like last year at the end of the year, they ended up being closer to a 50% stock, 50% bond allocation, but when everything's going well, it's 70-30. So it's more of a behavioral type of investment approach to help those clients.
And if you pull back up Justin's list of holdings in the tactical portfolio, I also saw S&P Emerging Markets and up there, SPEM. Carolina, you sifted through the 13F filings for some prominent investors, and Bridgewater dumped some emerging markets very recently, just before the recovery in the prices for EM.
That's right. I mean, Q4 has definitely painted a different picture for risk than we saw in the previous quarter. And the best way to sort of measure that big money, those big money bets, is through these 13F filings. And we saw overall hedge fund ownership of EEM drop to its lowest, actually, since 2010. And if we look more specifically and pop the hood, you're right, Bridgewater basically halved its exposure to EEM. Tudor Investments totally cut back on it. But what we're seeing in sort of replacement of that is Bridgewater making some more specific EM single country bets. So putting more money into the Taiwan ETF, into Brazil, into India. It's sort of on a roulette wheel, you know, instead of betting black or red, you have Bridgewater sort of moving their chips onto these specific numbers.
Another fund in there that I got to ask about, it's a fascinating topic, is small cap value. A couple months ago, Michael Burry, famously of The Big Short, came out and said this is the area he likes. A lot of people started, it actually worked for a month, and it kind of flaked out a little bit. Then we had Marianne Bartels come on and say, don't buy this. Small cap value is going to give you head fakes all day long. You like it. Explain the rationale for holding SYLV.
So I like it from a fundamental standpoint in academic research, that there's a lot of evidence that supports small cap will do better over the long run, along with value. And we talked about value versus growth. So we're waiting for value to come back for the long term. But there have been a number of times where value and small cap have underperformed. And I just have it in there from a fundamental belief standpoint, not necessarily that I'm making a bet that small cap value is going to come back. Even if small cap value was overpriced, it would still be in that model because I fundamentally believe in it for the long term.
Now, Michael Burry is someone that came up on Twitter, and Eric is a devoted follower of FinTwit. What do you make of that community, that area of engagement in terms of ideas? Is it a good place for you to test out ideas, or is it some place that you want to avoid because of the group bullying?
It is a great place to test out ideas and a great place to also learn. So I'm actually on a Twitter hiatus. So I gave up Twitter for the month of November just to kind of take a break and get away from it. But the community itself is extremely welcoming and very engaging, and you can approach them. But there's a lot of information from white pages to blog posts. You can reach out to the people writing it to learn from it. So it's an amazing community. I don't know of any other community that you might find on Twitter that could even touch what FinTwit's about.